Suppose two balance sheets are given as on 31st March 2010 and 31st March 2011. Cash 5,000, 9,000, furniture 10,000, 9,000, 10% investment 10,000, 6,000. Total 25,000, 24,000. Capital 10,000, 15,000. Provision for tax 6,000, 9,000. Creditors 9,000, 0. Total 25,000, 24,000. And the net profit for the year was 9,000. This is the additional information. So you are asked to prepare cash flow statement. So I strongly suggest that you should make capital account if it's a firm's books. You should not go ahead without preparation of capital account. So in this question, what I feel, we should prepare two accounts. First of all, capital account, then provision for tax account. And number 3, you should make furniture account for the convenience of this question. Number 1, capital account. You know, on credit side, buy balance BD. On debit side, to balance CD. Two drawings, buy fresh capital. Buy net profit, to net loss. So buy balance BD is 10,000, to balance CD is 15,000. Buy net profit 9,000, because it's clearly written in the question that the net profit of the firm was rupees 9,000. So on credit side, the total is 19,000, and on debit side, it is only 15,000. Now the question is, one item is missing on debit side. Either it should be net loss or it should be drawings. It cannot be net loss because the firm has made profit. Then what it is? It is drawings. So one thing we have found that there were drawings of rupees 4,000 in this firm during this year. Now, provision for tax account. I have already explained you how to make it. Buy balance BD, to balance CD. Buy profit and loss account. In the bracket, you will write down provision for tax made. To cash, and in the bracket, tax paid. So, okay, buy balance BD, 6,000. I have taken this figure from the balance sheet. And to balance CD, 9,000. Now, the question is silent that how much money was paid as tax to income tax department during this year. So if the question is silent, we'll assume that the last year's figures, I mean to say this 6,000, this is the amount that was paid by the firm to income tax department, means tax paid is rupees 6,000. So on debit side, to cash, rupees 6,000. Now debit side total is 15,000 and the amount missing on credit side is rupees 9,000. So by profit and loss count, 9,000, provision for tax made. Total 15,000 on both sides. Then furniture account. You know the format of fixed assets account. So I'm going to prepare furniture account. To balance BD. Buy balance CD. To purchase of furniture. Buy sale of furniture. To profit on sale. Buy loss on sale. And buy depreciation. So we can take the figures from balance sheet to balance BD. This is the opening value of furniture, that is rupees 10,000. And by balance CD means closing balance, that is rupees 9,000. So there is nothing more about the furniture account. So the total on debit side should be rupees 10,000. So to purchase of furniture nil, to profit on sale nil. Now the total on credit side should be rupees 10,000. So 1,000 figure is missing. Either it should be sale or it should be depreciation or loss on sale. So there was no sale, I'm going to assume. So there is no question of loss on sale. So one possibility is there, this is depreciation. It means this firm has provided depreciation of rupees 1,000 on furniture. That's why there is reduction in the value of furniture. Previously it was 10,000, now it is 9,000. So after that I have to prepare cash from operation. I would like to remind you again that I am preparing cash from operation in a rough manner. In the upcoming episodes, I will teach you how to present the making of this table in a proper way. At this moment, I am trying to make the concepts clear to you. So first of all, net profit, rupees 9,000. You know, it is given in the footnotes of balance sheet. So in the capital, only net profit, you don't find anything special which can be added or subtracted from cash from operation. Now provision for tax, it was 9,000. So to provision for tax made rupees 9,000. Then come to the furniture account. There was depreciation of rupees 1,000. So plus depreciation rupees 1,000. Now look at the balance sheet carefully. I have added all the non-cash items which were appearing on the debit side of profit and loss count. Of course, there is no profit and loss count given in this question, but I can well imagine these are the items you will find in the profit and loss count debit side. Now on asset side, there is 10% investment. Previously it was 10,000, now it is 6,000. What it means? This firm has invested money in some long-term investment, and last year it was 10,000, and you are getting 10% income. It means during this year the company must have got 1,000 rupees as interest from outside. This is the income, but this income is non-operating. So when we calculate cash from operation, we have to calculate the net profit without any effect of cash transaction and non-operating transaction. So this is the non-operating income. I will have to deduct it from the net profit. So minus interest on investment rupees 1,000. So total 18,000. So I can call it funds from operation, rupees 18,000, because this is the net profit without effect of cash transaction and non-operating transactions. But still, we have to remove the effect of working capital transactions. Working capital, you know, that is affected by current assets and current liability. Is there any current asset? No. Is there any current liability? Yes. In the previous year, the creditors were 9,000, now it is 0. It means the creditors have come down by rupees 9,000, or creditors have been reduced by rupees 9,000. I have already told you that current assets and cash from operation, they have got inverse relationship, and current liability and cash from operation, they have got the direct relationship. It means if there is a reduction in the current liability, then it will be reduced from the net profit. So in balance sheet, there is reduction of rupees 9,000 in creditors. So decrease in creditors will be deducted from funds from operation. So 18,000 minus 9,000 is equal to 9,000, and this 9,000 is cash from operation. So I have got this figure. Now I am going to prepare cash flow statement. You know, it is prepared in T shape. On left hand side there are two columns, inflows and amount, and on right hand side outflows and amount. So opening cash rupees 5,000. So now I will start looking at balance sheet carefully. Cash, I have already taken 5,000, and on right hand side I will write down closing cash rupees 9,000. Furniture, there was no sale purchase. Investment 10,000, then 6,000. What it means? During this year the investments have been sold for rupees 4,000. So the firm must have got money. So this is the investing transaction. You know, all investing and financing transactions are written individually in the statement. So sale of investment rupees 4,000. Then capital. You know, capital, you should look at the capital account. There were drawings rupees 4,000. So on outflows you will write down drawings rupees 4,000. Then have a look at the provision for tax. You know, provision for tax made of rupees 9,000 was added back to net profit to calculate cash from operation. But in this form, the tax has been paid rupees 6,000. So tax paid on outflow rupees 6,000. And cash from operation was 9,000. It will be taken to the inflow. Cash from operation 9,000. Cash from operation means net result of operating activities in the business. Means cash generated from operating activities. And then you have got 1,000 interest on investment. So if you get any interest on long-term investment, that will be your inflow. If you pay any interest on long-term loans, that's a non-operating item, that will be shown on the outflow. And this is the receipt of rupees 1,000, so it will be shown on the inflow side. Interest on investment 1,000. So total on both sides 19,000, 19,000. Question is complete.